Did the stock market already reach its bottom? That's the million-dollar question that's on everybody's mind. We've had a bull market for over a decade, which drove stocks' valuations to record levels. Then in March of this year, the S&P 500 dropped 34% from its most recent high, and since then, the stock market has took back part of the losses, recording some of the largest weekly gains in history. This has led a lot of us investors in the stock market asking, was that it? Was the 34% drop the fabled bottom? And will it be blue sky and upward stock market increases from here onwards? Or will the stock market fall further to reach a new low beyond the 34% decline? That's what we're going to talk about today in this video, with graphs and factual data. Hopefully after watching this video, you'll have a clear conviction on whether the stock market will have a new bottom in the near future. And at the end of this video, we also want to ask you to help us with something. First, let's quickly level set on what happened year to date so everyone's on the same page. We entered 2020 with the stock market very bullish about the year ahead. Even though China was shut down in January and February due to coronavirus, the impact was largely limited to a single country early in the year, and many investors in the world didn't fully appreciate the potential impact. The research analysts at Goldman Sachs, JP Morgan, were all very upbeat and continued upward trends in the economy and in the stock market. From January 2nd through February 19th, the S&P 500 grew by 4%. That's a 4% jump in about a month and a half's time, which is a pretty good return year to date. This early jump brought the S&P 500 to a record high of 3,386, which is the highest it has ever achieved in history. And again, that's primarily because investors wrongly believed that the impact of coronavirus was limited to only China, instead of spreading all over the world. By the way, we make new videos on investing and financial analysis regularly, so if you're new to LumoVest, consider subscribing to our channel. Then on February 20th, as it became increasingly clear that the virus was spreading outside China into other large economies such as South Korea, Japan, Europe, and the United States, the US stock market started to wake up to the threat of coronavirus and the damaging effect it'll have on the global economy. From February 20th to March 23rd, as the world's most advanced countries started shutting down their economies and enforcing lockdowns, the market realized that the global economy is entering a recession. Millions of people laid off, businesses forced to close, supply chains disrupted, oil prices crashed, and banks faced defaults and losses on their loans. It quickly became very obvious that the global economy is entering a recession. In response, the S&P 500 declined 34% from the February 19th peak, falling to 2,237 on March 23rd. So the market declined by a third of its value in the span of just a month. That's the fastest decline of this magnitude in history. But since then, from March 24th through April 13th, the market rallied. Fueled by optimism that the government is bringing the coronavirus under control, the trillion-dollar economic stimulus package from Congress, and the Fed's usage of its monetary tools, the stock market rebounded and increased by 27% from its March 23rd low. This rally cut the decline from the peak from 34% to just 16%. So to date, the stock market has only declined 16% from its near-term peak. So that's an overview of the events that has transpired so far, which will serve as the basis for our discussion on what's about to come. Will the stock market continue to rally from here and get back to its upward trajectory before the virus happened? Or will there be another sell-off, pushing the stock market to a new low? Here's the case for a possible new bottom. To put things in perspective, we'll take a walk down memory lane and look at how the stock market behaved during the last two economic recessions in modern history. When we talk about how much the stock market has declined, we're calculating it off of the index's most recent peak and its bottom. During the tech bubble recession, the S&P 500 crashed 49% from peak to bottom. During the 2008 financial crisis, the index declined a whopping 57%. So in one recession, the stock market wiped out 49% of the value, and in the other recession, the stock market wiped out 57% of the value. Many economists believe that this coronavirus-triggered recession is a lot worse than the other two. Analysis done by the World Trade Organization shows it'll be far worse than the 2008 financial crisis. Economists at the IMF, International Monetary Fund, says this recession will be worse since the Great Depression. It kind of makes sense because in the current situation, many industries are forced to a halt. Restaurants, movie theaters, airlines, hotels, cruise lines, tourism, sports, retail stores, casinos, and many other businesses are shut down. Millions of people lost their jobs. The U.S. Treasury Department says unemployment rate will reach a record 20%. Geographically, not only is the United States significantly hurt by the virus, but so are other countries all over the world. In 2008, it was mainly the United States and Europe. Looking at this map of global coronavirus infections, we can see that the pandemic is hitting countries all over the world. And when we translate that into economic impact on GDP, you can see here that the economic decline is a lot more severe than what happened in 2001 and 2008. The American and European economies, which are the orange and light blue lines, are projected to fall over 5% in 2020. Worse, even emerging markets, which are supposed to be the source of economic growth, are now entering economic recessions as well. So from this chart, it's very clear that the economic damage is not only of a greater magnitude, but also broader in geographical scope than the 2001 and 2008 recessions. But despite the much larger economic damage, the S&P 500 has only declined 34% through the March 23rd bottom. If we take the recent rally into account, the S&P 500 has only declined 16% from its February 19th peak. Now, if you believe that this recession is more severe than the previous two, then that means there will be plenty more downside in the stock market. It doesn't make sense for us to undergo the worst recession in nearly 100 years, but for the stock market to only decline by 16% from its peak. In addition to the percentage decline from peak to bottom, it's also important to look at how long it usually takes for the stock market to go from peak to bottom. During the tech bubble, it took 929 days for the stock market to decline 49% and reach its bottom. That's 2.5 years. During the 2008 financial crisis, it took 517 days for the stock market to decline by 57%. That's 1.5 years to go from peak to bottom. During our current coronavirus crisis, the date of the peak is February 19, 2020. So it hasn't even been that long, and historically speaking, it'll take a couple more months, potentially a year, for the stock market to run its course before reaching the true bottom. Naturally, a logical question is, why does it take so long for the stock market to reach the bottom? Why does it take a few hundred days for the stock market to go from peak to bottom? There are two reasons. The first reason is that information comes out over time. Employment data comes out every week and every month. GDP data comes out every 3 months. U.S. companies report earnings every 3 months. European companies report earnings every 6 months. And in between, you have a variety of other economic data being published by different agencies. Investors in the stock market base their investment decisions and outlook on these factual data. Without these data, they would be shooting in the dark. But these data come out over the course of a couple hundred days because they measure real business activities over this time period. As these data are measured and released, investors digest the state of the economy and the stock prices go up and down accordingly. The second reason is that it takes that long for the economic recession to run its course. The stock market prices, which is really just how much investors are willing to pay to invest in different companies, follow the actual economic activity, how much money businesses are making. The economy doesn't go from growth to recession and then back to growth in the matter of days. You can't turn around the economy overnight. It takes months to years for the economy to go through its cycle. It takes that much time to turn around the economy so that investors can see light at the end of the tunnel. For these reasons, it takes a couple hundred days for the market to go from peak to bottom. In our current coronavirus situation, the stock market peak was on February 19th, 2020, and so we're still extremely early in the game. And in the coming months, as the economy continues to absorb damage and as factual data about the extent of this damage come to light, it's possible that the stock market will adjust accordingly and reach a new bottom. So the takeaway here is be patient. It takes a couple hundred days for the stock market to go from peak to bottom, and it really hasn't been that long since February 19th, so the current market still has a long way to go. At this point, we've looked at how much the stock market typically declines during recessions and how many days it takes to go from peak to bottom. But equally interesting is the path it takes to go from peak to bottom. That is, the pattern of the stock market movement from peak to bottom. Notice that the stock market doesn't just nosedive in a straight line from peak to bottom. It declines to reach a first bottom, rebounds to a smaller extent of the previous decline, declines again to reach a second bottom, and then rebound again to a smaller extent of the previous decline, and then it declines some more to reach a new bottom. This decline and rebound happen for multiple rounds before the stock market capitulates to reach its true bottom. So the path to go from peak to bottom will involve multiple turns of declines and rebounds. That's normal. That's how the stock market works. In other words, when the stock market drops significantly, you would expect there to be a rally before the stock market drops even further to reach a new bottom. During the tech bubble, the market first declined by 28%. Then it rebounds by 19%, which is a smaller magnitude than the 28% decline. Then it declines by 26% to reach a second bottom, before the market rebounding by 20%, which again is of a smaller magnitude than the 26% decline preceding the rebound. Then it drops by 31%, and then it goes up by 21%, and then drops by another 20% to reach its true bottom. So multiple rounds of back and forth between declines and rallies, with each rally smaller than the preceding decline, before the stock market reaches its true bottom. A similar trajectory played out during the financial crisis. As the stock market begins to realize that there's imminent economic trouble, the stock market declines by 19% and then rebounds by 12%. From here, it declines by another 15%, followed by a 7% rebound, then it declines by another 42%, followed by a 23% rebound, and then another 27% decline to reach the true bottom. As it was the case during the tech bubble, the stock market takes the path of multiple turns of declines and rebounds. Again, notice that each rebound came at a smaller magnitude than the preceding decline, gradually bringing the market to the bottom. So let's recap logic flow underpinning the case for a new bottom. The stock market, as measured by S&P 500, is the price at which investors are willing to invest in the publicly traded companies. It follows actual economic activity, which measures how much money these companies will make. During recessions, the stock market typically crashed by 50%. It dropped by 49% during the tech bubble and 57% during the financial crisis. The more severe the recession, the steeper the decline. It takes a few hundred days for the stock market to decline that much, and it gets there through multiple turns of declines and rebounds before reaching the true bottom. By all accounts, this coronavirus-induced economic recession is broader in geography and more severe than the previous two recessions of the century. It has only declined by about 16% from the February 19th peak. The stock market is rallying right now after crashing in March, but that's expected because the stock market undergoes multiple turns of declines and rallies, so it's possible that we're experiencing that first round of decline and rally before the market proceeds to the second round of decline to reach a new bottom. Thanks for watching, guys. Now, we mentioned in the beginning that we need you to help us with something. We've been working on this YouTube channel really hard over the last 2 years, but YouTube isn't really good at promoting startup channels. So we're turning to you for help. If you like this video, please share it with at least one friend. It helps us get more views and grow faster, which allows us to make more and even better videos for you. Thanks so much, and see you guys next time.